Good evening and welcome to the Digital Finance Analytics livestream event for the 19th of November 2019. I'm Martin North, the Principal of Digital Finance Analytics. I'm glad to have you on board this evening. We're going to have a very interesting conversation tonight, I think. And as normal, we'll go through a few slides to start with. And from there, we will then have opportunity to ask questions, discuss some of the issues that I think will be top of mind at the moment. And just so you will know, at the moment, I won't be looking at the live stream chat. So if you've got a burning question, just hold off for a little while we go through some of these early slides. So what I'm going to do to start with is just to go through a few opening remarks, if I may, just in terms of the running order. So this introduction, talk about the house rules, talk about our models. There will be some people on who may not know about our models and how they work, so it's important that we get that explained, I think. A few key slides just to sort of set the scene. Then we'll go into the questions and answers, and then we'll sign off. Typically, this goes for about an hour and a half, plus or minus, and we'll probably try and keep that again tonight. Just in terms of the house rules, a few things that it's pretty important to remember. Firstly, this is not financial advice. I'm not qualified to give financial advice. I don't know your personal circumstances. What I can do is share my experience and my analysis, and if it's helpful, that's great, but go and get some advice elsewhere if you need specific advice, because it's not something that I can provide. Please play nice in the chat room, no racial slurs. This is a moderated stream, and if anybody gets out of order, we will actually deal with it. And worst case, we have dismissed people in the past. We don't want to do that. There are so many great people who are part of this community, so many great ideas, and it's a pity to spoil it. So just please play nice. And this is as at the 19th of November 2019. If you're watching this subsequently, you'll know whether in fact I was right or whether I was wrong. Property prices probably went massively higher than everybody expected, but we'll see. Maybe not. If you want to get my attention, then please use @WalkTheWorld. The reason for that is that there are always plenty of other conversations going on the live stream, and it's often the case that I can't actually see them all. So if you use @WalkTheWorld, there's a really good chance that I'll be able to see your question and respond immediately. We have enabled Super Chat, and this has got a couple of facets to it. Firstly, you can essentially make sure that I see your question. And secondly, if you feel that you would like to contribute to help us to make more content, then you can do that via the Super Chat in real time. I think I've explained before, I'll say it again, any contributions that we receive go directly back into making more content. There's no profit involved here, it's just basically to help us to do more of what we do. So it's greatly appreciated, and those who have already contributed tonight really appreciate it. Makes a huge difference to enable us to do what we do. So just in terms of the DFA model, this is how it works. So essentially we run surveys, household surveys, SME surveys. We suck information from all sorts of different sources and essentially put it into our core market model. Our core market model is our analytic tool, and that's really important to understand. So when we talk about things, we talk about it not from the point of view of just high-level ideas, but we've actually got data to support it. And so this is very much a data-driven conversation. And in the current environment, I think that's really important because, frankly, there are a lot of people out there with big opinions and no data. What we try to do is to have the data and then build some opinions around it, but effectively it's showing the data, which is the thing that really DFA is about. And then that feeds our industry models, it feeds the blog, it feeds the YouTube channel, and we also do consulting for clients as well. And some of those consulting engagements help to fund what we do here as well. And we slice and dice the data so we can look at it from different types of customers, different types of households, different geographies, and we use segmentation. Segmentation is a way of understanding how different types of people behave. And so that's a very powerful lever when it comes to trying to understand what's going on. So we can slice and dice. It's like a Rubik's Cube. We can mess around with the data and essentially begin to see how the various elements work together. And now let me just touch on a few headlines in terms of up-to-date information. The Reserve Bank released their minutes today. Very dovish minutes, actually. What was fascinating about that was that essentially they're saying global markets were signaling a decline in pessimism. Maybe. Well, bond rates are a little bit different from where they were, but there's still a lot of noise out there. They said the established housing market is picking up. And that should have positive spillovers into the broader economy, i.e. they're banking on housing basically rescuing the economy. And further evidence on spending by households is required before drawing a conclusion on the effects of the tax cut. So they're basically giving it a lot more time. My own read is that households hardly notice those tax cuts, hardly notice the interest rate cuts. And therefore, that's one of the reasons why households are relatively messing with their budgets and not spending as much as perhaps people would like them to spend. And again, it's a question of whether the Reserve Bank is right that households will turn that around or whether they won't. And we'll discuss that a bit later in more detail. Secondly, they said they recognise the negative effects of low interest rates on savers and confidence. And they also discussed the possibility that a further reduction in interest rates could have a different effect on confidence than in the past when interest rates were at a high level. And that's a very important observation, because what it suggests to me is that they are actually going to be quite cautious about taking rates lower. In fact, this signals to me more likely that they will do alternative strategies, maybe QE or something rather than taking rates lower. So they probably will cut rates again, but they do recognise particularly the pressure on savers. And, as I keep saying, there are 1/3 of the population who rely on savings from deposits on banks, and they're being definitely screwed to the floor at the moment simply because the rates are so low. So this is a very important observation from the Reserve Bank, I think. Our mortgage stress data was up again. There's a post that came out a couple of weeks ago. Vanessa asked me earlier on what's going on there. Watch that video. We actually went through and described the postcodes and some of the key characteristics. More people than ever now in mortgage stress, and it's pretty sort of sobering to see that it's not just now the West Coast over WA or up in Queensland, but we're seeing more and more people in New South Wales and Victoria now getting into difficulty because incomes have not grown since 2008 and 9 for many people. Cost of living continue to rise, and whilst interest rates have come down a little for some people with mortgages, in the scheme of things, it's insufficient to cover the other costs that they're now facing. So mortgage stress, I think, is going to get worse before it gets better. Now, interestingly, the default data from the S&P was a little down this time, just marginally. It was 1.41 last month, it's 1.36 this month. But though it's interesting to note that in Western Australia it was a little higher. It was down a little in New South Wales. It was up a little in South Australia, down a little in Queensland, and a little up in Tasmania. So, minor variations. Thing to note here, though, is that the 90-day default rates are still relatively high. And, what S&P said was that this is a seasonal variation. It's nothing much more than that. So it's pretty important to understand that whilst, it might, from a headline perspective, look good, actually the reality is probably not so good. And just to say thank you very much, New Zealand content. Yeah, we'll try and get some more New Zealand content. Joe Wilkes is back. So Joe and I will be working on some more shows about New Zealand. Joe's been rather tied up the last few weeks, so hopefully he'll be back and working with us again quite soon. Now, going back to defaults, the delinquencies from Genworth, one of the LMIs, was up, and you can see that. We did a post on that some time ago. ANZ reported rising delinquencies, particularly 90-day plus, across the states. And the Reserve Bank, both in their latest speech and in the Statement of Monetary Policy, made the point that mortgage arrears are rising, including 90-day plus arrears, that the extent of housing loan arrears has definitely increased, and it's just worth highlighting that middle chart. That doesn't include the 30-day delinquencies. It's only from 90 days and above. So in a way, that's artificially stating the true state of delinquencies. But this is the other interesting thing. Mortgage arrears rates are significantly high, and there's a lot of negative equity. So effectively, the light blue is loans in negative equity. WA has issue with negative equity. What I would say, though, is that 2 points about the RBA data. Firstly, they're using securitized data, so those loans are cherry-picked, which means that they're not necessarily the worst of the loans. And secondly, the mark-to-market that is done at a very high level, what's called an SA3 level, which is a very high level. It's not coming down to individual postcodes or individual properties. When you do that, as I do in my modelling, then what you realise is that, in fact, negative equity is a lot higher in some places than others. And so the RBA is understating the true state of play with regard to negative equity, even now. And then we can debate whether home prices are moving up or whether they're not, but that's another conversation for a moment or two. Now, just in terms of our financial confidence index, the point here is that the data from our survey shows that it's low now than it's ever been, 83.7, and it's not just one or two household segments, it's not just one or two geographies. There is a very significant pressure on confidence now. Households are really feeling it. Low income, high rising costs, a lot of pressure in terms of some of the broader issues with regard to the economic performance that's around at the moment. So confidence is pretty low, and what's quite interesting here is that it's definitely impacting people's decisions in terms of what they're spending their money on or not. It's also influencing their decisions in terms of thinking about getting a mortgage or buying a property. And so one of the reasons why I'm a bit skeptical of some of the most bullish news on home prices is that the real households that I interview are just not interested in buying at the moment. And in fact, ANZ came out today with more data on confidence. So the ANZ confidence indicator was down again. And they basically said that the labour market information was pretty weak. Yep, agree with that. And wages are still subdued. Yep, agree with that. And they actually said that the renewed weakness in the weekly reading of inflation expectations will be a concern for the RBA. That's true too. So pretty much wherever you look, there seems to be issues. Now, the interesting thing is that CBA came out today and said, well, actually, of course, it's all bad other than households are massively interested in buying property. And I have to say that my analysis of what's going on through my surveys just does not resonate with CBA. So we'll see who's right. But I'm a bit more sceptical than they are at the moment. Business confidence, of course, is also falling. This is the NAB data. Both conditions and confidence are a bit off. Retail, of course, very significant pressure. Wholesale sector. It's interesting that mining and recreation and personal services are more positive. And finance and property are just slightly in positive territory too. But this is the real interesting thing. Retail, wholesale. And construction was a lot higher a couple of years ago. It's come way back now. So my own view is that construction will continue to be an issue. Retail, of course, continues to decline. 0.2% last month was the growth rate. That's very low. And, of course, people are now worried about moving towards Christmas. I think it's highly unlikely that we're going to see a significant spike in retail spending this side of Christmas. Households just don't have the funds. Where they do have funds, they're preferring to pay loans down rather than actually spend more at the shops. So I think this is a forward-leading indicator of more trouble ahead. And, of course, trend wages are weak. I don't expect any difference ahead. Public sector is a little better. So if you're in Canberra in the public sector, you're doing quite a lot better than if you're in the private sector in some of the other states. And it's actually quite interesting that the issues here is that the private sector trend is actually falling away further than the public sector trend. So there's been some... for example, in Victoria, in the public sector, there were some wage rises that were actually quite extended that's come through. But the private sector is where the difficulty is. And that's a combination of wages not growing and also underemployment being a significant factor too. Trade balance was a bit better than expected. A lot of people were expecting a much lower number. But of course, we're very reliant on the iron ore price, which has continued to slide. So I wouldn't be surprised to see some more pressures there as well. And, of course, new lending flows. It's worth just looking at this. So this is basically the flow data from the ABS. So this is new loans coming in. And it's interesting how everybody's been saying, massive recovery in new loan flows. Well, just be careful. Total new flows for owner-occupied loans were 2.5%. But you can see, if you look at the trend carefully, that there was a bit of a rise in May, June, July, and then it's sort of going sideways again. So the growth rates are actually not that extended, and investment loan growth for new loans is even lower than this. So to my mind, there isn't a massive amount of evidence of massive amounts of loan growth. And I did a video on this. You might want to have a look at it if you want more details on it. We went through it by each of the categories of lending and even some of the geographic areas as well, because it's not uniform across the country. So yeah, there is some growth, but it's not massive. And of course, total credit growth, housing is 3.1%. That's the lowest it's been forever. It's massively down. Owner-occupied housing is still at 4.8%, which is quite a good number. Investment housing was down minus 0.1%. This is on a 12-month rolling basis. And the point to make there is that business lending is also down, and personal credit is down too. So pretty much wherever you look, the consequence of all this is that there is less credit being written, more debt is being paid off, and that's one of the reasons why the total debt in the system is not growing. So the so-called credit impulse, in other words, the rate of change of credit, is still negative. And you'll see that that becomes quite a significant factor when we think about movements in home prices. Now, a few other points. CoreLogic said listings and new mortgages were down. This is the latest data out today, and you can see there that over the last 12 months, a 24.1% drop in listings in Sydney, 16% in Melbourne, overall 16% down, and you can see there that in Perth, again, 16%. These are big drops. So we know that the total throughput of housing is significantly down on where we were even a year ago. And the other interesting point is that CoreLogic is saying that the mortgage index, that's how they measure the flow of mortgage business, is also down as well. So you have to say, in that situation, with the mortgage flows down a bit and with the listings down a bit, is this a bullish property market? Does it look like it? Not sure. But that said, CoreLogic has come out with the latest and greatest data today, saying that in Sydney, prices are now up 6.26% over the quarter. There was a 0.23% change on the day. In fact, John Adams and I did an emergency post tonight on the Interest of the People channel because we feel this is such an important story. Melbourne, of course, up more than 6%. And it's worth saying that both of those areas are still underwater from peak, but over the last year, they've now moved back into positive territory based on the CoreLogic data. But just to remind you that REA, who has the biggest flow of transaction data coming in through their Home Track series, came out with a post narrative said 0.8% price rise in Sydney over the quarter. So who's right? Is it 6.26% over the quarter, or is it 0.8% over the quarter? I don't think they can both be right, but it's interesting how all of the property spruikers and indeed all the media fixate on the CoreLogic numbers. And so one of the things that John and I are doing is just making the point that when you actually go to a single source and basically just rely on that single source without any cross-checking and cross-referencing, that can lead to significant error. And there are some things we know about the CoreLogic index. For example, they lost the Home Track data feed some months ago because the contract ended. But there are other things we don't know because it's a very much a black box mechanism. So we'd be quite interested to get more information from CoreLogic about precisely what data flows come in and what assumptions they make to be able to come up with their indices. But I have to say, my own data and the REA data is much more aligned. So I tend to think that REA probably has a better finger on the real pulse. And by the way, I also get a lot of information from a lot of real estate agents. And there are some who are saying, no, it's definitely hot in some areas. But I'm also getting more who are saying there's no evidence. Transaction volumes are really low, prices are really low, and we're seeing no recovery at all, particularly units, and particularly in the Western Sydney area, for example, and some of the outer suburban areas in Melbourne. Perth is still struggling. Some areas of Queensland are struggling as well. So I think we need to be very careful about leaping to conclusions that suddenly the property market is remarkably buoyant. And just to give you a little bit of sense of that, Tim Lawless came out with this tweet saying, cause celebration or commiseration. According to CoreLogic's daily indices, Sydney housing values moved back into positive annual growth today following Melbourne, where the annual change turned positive earlier in the month, but is still down 8.8 and 4.7 from the 2017 peak. So these sort of U-shaped recoveries, a bit sceptical, I'm afraid, at the moment. And just, this was something that came over Twitter. If you take the annualised rates from CoreLogic and apply it to Melbourne and Sydney, you can see that basically it's saying that Sydney prices are going up 45%. It doesn't actually really look anything like right. So I'm just very nervous about these numbers at the moment. I think there's more work to be done to really understand what's going on. I'll just say no more than that. We're going to do some more work, John Adams and I, to try and figure out what's really going on. Now, just in terms of our scenarios, one of the things we do off our model is to look basically at the way that our models predict what might happen. Now, scenarios are a way of trying to just paint some pictures of potential futures. As you know, I never say definitively X will happen. I say it could be this, it could be that, it could be something else, despite the fact that I'm often misquoted. None of these scenarios may turn out to be right. Things change. We often change our scenarios. But we use this framework to be able to help discuss what's going on. And this is effectively the way to think about it. So we think of business as usual. In other words, following the RBA. So if what the RBA says is going to happen, what would happen? Things are going to get better. So that's basically a slightly more negative scenario where effectively we get high levels of unemployment and a few other things going on. Not yet doomsday, Armageddon, Ireland 2.0. That's basically following Ireland. And Iceland, which is our doomsday scenario, where effectively banks fail and don't get bailed out. So what we've done is we've actually updated our scenarios. Not a huge amount of change this month. The first thing we've done is we've accepted that if the RBA is right, and if they keep doing what they're doing, and effectively if they do more QE and do money printing and those things, and give the banks more money to lend, and if you continue to follow the government's line of doing more stimulus to encourage it, you could see home prices in, let's say, 24 months' time from now, 12 to 15% higher. That's certainly a feasible scenario. It's not my central scenario, but I reckon there's a 20% probability on that happening. The question is the Reserve Bank right in making the calls that it's making? Remember, the Reserve Bank is suggesting that unemployment should be down at 4.5%. Don't think that's going to happen. It's going to be closer to 5.25 in my view. Amount of mortgage stress, roughly where it is, maybe slightly higher. Bank losses, slightly higher. But effectively enough momentum in the home sector because of the government stimulus and because of the ultra-low interest rates and because of the fact that money will be handed to the banks to lend, or be forced to lend because they'll be charged negative interest if they don't lend. So that's sort of the baseline scenario. Then if on the other hand we see higher levels of unemployment, and as a result of that we see more credit rules, fiscal stimulus, more QE, the chances are that we're going to see prices in a couple of years' time negative rather than positive, compared with our baseline back in September 2018, just to be clear about where we're starting from. I think we are seeing potentially a small uplift in prices, although I don't think CoreLogic is right in terms of how much of it. I'm expecting a little rise, but then next year I fall away again because the broader economic parameters, to me, are not sustaining a more significant rise. Not yet doomsday is a more significant scenario where we've got higher levels of unemployment, where effectively we've got a bank gets into difficulty because of that high level of unemployment. The default rates are quite a lot higher, and that's got a 25% probability. The previous one, I moved up from 25 to 28% this time around. The Armageddon scenario, which is effectively the bail-in and the bail-out and very, very high levels of unemployment and liquidity crisis and international issues flowing in over the top, leads us to still a risk of a 30 to 45% fall. Now, the 30 to 45%, as I discussed the other day with the swagman, was that over, if you look at it in absolute terms, true value on property is 30 to 40% below where it currently is. So it's coming back to fair value, which is why we come to that number. And then the last one, where effectively a bank is allowed to fail, I only give that now a 2% chance. I'm pretty sure that if a bank got into difficulty, there will be bail-ins and there'll be bail-out and all those things. But nevertheless, I think it's highly unlikely that a bank would just be allowed to fail because of the ongoing consequences if that was to happen. So that's my current scenarios. And you can see the relative weighting there. So basically what we're saying is that, somewhere in this couple of two scenarios here is probably the most likely scenario, but frankly, it's quite difficult to know precisely how this is going to play. Too many variables, too many externalities, and frankly, a lot of political will to try and support the property market to, come hell or high water. Never mind the high levels of debt, never mind the fact that many households are really in difficulty. Okay, so that's my introduction. I hope that's been of some use to you. Let's now go back to the chat, and I'll pick up some of the questions and then see where we go from there. I'm just going back up through the chat to see where we are. Okay, this is Sandy saying, from regional South Australia, do you see rental markets going forward for those of us who need to rent? Thank you for your hard work. Thank you, I appreciate that. And look, rents are definitely not rising at the moment. In fact, it varies a little bit location to location. So certainly in Sydney and Melbourne, particularly in Sydney, rents are down. As a result of that, what it means is that people can actually rent a property potentially at a lower rent than previously. In the West, some rents are down 30%, perhaps a little more. In South Australia, the rental market's a little tighter, but I don't see much rental growth. And given the scenarios that I'm looking across the country, I think it's unlikely that we're going to see much rental growth in the next little while. I think it's more likely that we'll continue to see this sort of slide. And by the way, our modelling suggests that somewhere between 50 and 55% of people in rent are in rental stress. So we know that they have got financial issues as well in terms of their ability to be able to support their repayments for rent. And that's one of the reasons why I think that I'm a little bit sceptical about all of this massive demand from people who would aspire to buy property, because many of them are renting at the moment. They've got cash flow issues at the moment. And if you look at their cash flows, they wouldn't be able to afford a mortgage. So it's definitely part of this conundrum. I think it's a bit unlikely that we're going to see massive rental rises. And by the way, there's still a lot of new properties coming on. These high-rises that are being built and not sold. In some cases now those are being let for a period of time to try and get some money come in, even if it's let by the developers. So there's more supply in a number of areas. Canberra is a good example, Sydney, Melbourne in particular. I see it on the Gold Coast as well, and in Brisbane. So I think if you're a renter, you may well be able to do rather well. And by the way, some of the things that my survey suggests is that people have had more choice than previously, so that's quite interesting. Okay, this is from Lost Aussie. If the Aussie market relies solely on housing, the government has no choice but to pump money into keeping it propped up. Is it possible that the country will end up going broke? And well, it's interesting. Can a country go broke? Well, the answer is, I suppose, in theory, yes. Look, the fact of the matter is, if you look at the government debt, it's actually quite low relative to many other countries around the place. So there is fiscal space. It's one of those sort of terms that's thrown around the place. There is fiscal space. So if there was a wish and a need to effectively puts investment into the economy, it could be done. But of course, the government is essentially not wanting to do that because it wants to protect its surplus, because it made a promise, silly promise in my view, but that's there. I think we've got two factors that we need to think about, because I don't think it's public debt that's the issue, it's private debt. And there's two aspects of this. Firstly, the private debt in households. We know 191 is the debt to income ratio. That's one of the highest in the world. Debt to GDP is number 2 after Switzerland. We are massively leveraged, and of course it's not uniformly spread across the whole country or across all households. There are lots of households with massive amounts of debt. And by the way, the debt is often understated because of the way that loans are reported. That's another story. The other is that we've got big debt internationally. So a lot of our corporates are borrowing internationally, and our net debt is more than $1 trillion internationally. And it's that what I'm quite concerned about too, because if the exchange rate moves, if liquidity freezes, if in fact international investors cease to think that Australia is a good place to invest in, then that debt could become a problem. So those two factors, I think, are the ones that I'd be looking at in terms of how this may play out. Now, what the government is trying to do, and what the Reserve Bank is trying to do, is to try to pump up the housing market to stop values falling further, hopefully because people then will feel a little bit more wealthy and then may go and start spending again. I'm not sure they will, but that's certainly what they think. They're also trying to encourage more demand so that the construction sector picks up. Of course, construction is absolutely on the floor at the moment. There's very low levels of new approvals compared with what we had previously. We're seeing a lot of construction people with minimal work now compared with what they had previously. And we're seeing a number of half-finished buildings where the builders have actually just gone out of business. There was a post I did the other day about bankruptcies in the construction sector. So all of that is a very critical issue. Now, What we may see is a stimulus from the government looking specifically at infrastructure. And in fact, there were some announcements today in South Australia and a couple of other areas too, recently, to essentially try and drag forward some of those shovel-ready projects to try and actually apply some additional economic momentum. The question, of course, is how successful that will be and to what extent can the construction sector that's been in the high-rise sector switch across to building bridges or other things, and that'll be an open question. So I think it's not so much we're going to end up completely broke. I think that we're just not going to see much growth. I think we're going to see the debt growing more. And then, of course, the question is with little growth and bigger debt, how is that going to be serviced? And that's the longer term question. I think the final thing to say is, of course, that there are people like the MMT school who say, well, actually, this is precisely the time with interest rates ultra low that we should be borrowing more and we should be investing in, big infrastructure projects and even, things like universal incomes and those sorts of things. Maybe there are some consequences of that, though, in terms of inflating the debt and having to deal with it later. But it's worth looking at some of those alternative models, and I probably can't go into MMT in detail tonight. I think it's probably time to have another conversation about MMT, because certainly in the US, some of the candidates over there in the US are definitely talking about MMT as a way of trying to actually do a reset, a green reset, to create essentially momentum around doing new projects and funding them differently. So that may be something. But again, the question is, does that lead us to the right outcome? Maybe, maybe not. So I hope that's helped. Complicated, but that's my view. Okay, what else have we got? Questions. Okay. Nishant says, DFA should start producing your own index. Well, now that's interesting. I do have data, but the things about indices, I should say, is they're averages, right? And the problem with averages is they don't tell you anything really useful, right? I'm always a great believer in getting granular and looking at very detailed information down to a postcode level and below. So I know that there are a number of postcodes in Sydney, for example, where prices are at 15-20%. Most of those are at the top end of the market. Most of those are on very, very low volumes. And most of those are individual properties with very significant characteristics that are one-offs. I also know that there are other postcodes, for example, North Ryde, where prices are still down 30% in high-rise, or if you go out west to Liverpool and Campbelltown, where prices are down 20%. And those are houses as well as apartments. And we also know land prices that get down there too. So if you take the positives of, the top end of the market and the negatives of the western suburbs and jam them together, what do you get? Well, you get something which doesn't tell you very much at all. So that's the real dilemma about an index. And in a way, I respect REA a bit, because up till now they haven't come up with high-level indices. They've deliberately reported the information in a realestate.com.au at a postcode level. And I actually think that makes more sense, because in a way, these indices take on a life of their own, right? And then they start driving decisions and driving behaviours and driving the media. So I'm not sure whether that's something I really want to do. But actually, I do have data. So, and I have shared some of that data with some people, but at a more granular level. Heisey says, what about stamp duty as a check? Yeah, well, stamp duty volumes are way down, of course. And good to see you on. And love your show, by the way, as well. The interesting thing about stamp duty is that it's down significantly, right? And there's a lead time, of course, because it's 3 months after the transaction data. My analysis of stamp duty is that volumes are down, but it's very difficult to get granular information on stamp duty because it's very aggregated. So that's part of the issue. And the value of general data, of course, is also slow to come through. We will get some more of that later. So it's tricky to try and actually really triangulate precisely what's going on. I'm just very sceptical of all of these massive price rises that people are talking about. Eric says, you're my hero. Oh, shucks. Well, I don't know about that. But look, I'm just talking about the things that I've thought about and do analyse. And hopefully, it's just an alternative view. It's a way of thinking about what's going on. And it's a way, perhaps, of helping people to make better decisions. That's what this is about, really. Okay, what else have we got? 5% only for doomsday. I was looking forward to doomsday, says gold, silver, cryptos. Well, there are different scenarios. The thing about scenarios is it gets you engaged around how these things may play out, right? And that's really what I've tried to do, because it's very hard to be able to actually be as predictive and definitive. And again, the swagman and I discussed the fact that Steve Keen was very definitive about 40% over a certain period, and of course everybody just took him at his word and basically said, see, it didn't work. With scenarios, you can actually be a little bit smarter in terms of the way that you talk about things. And, the swagman conversation is really important. If you've not seen it, I do recommend that you watch the conversation that Joseph and I had, because we identified that there is an intrinsic value question. There's a psychology aspect to property prices. And, there are other factors too, like the propaganda or like the narratives that are also driving it. And those three things together explain the dynamics of the property sector. It's a very interesting conversation, a very important conversation, and helps to begin to explain what's really going on, I think. Okay, good. I think I've probably caught up on most of the conversation questions. What's that one? In regards to negative interest rates, based on the RBA, BBSW and the retail bank, negative rates might not work, and at some point banks will have to readjust their risk. Yeah, very, very interesting point. Now, let's talk about negative rates, because I had several questions in the pre-conversation about this, pre-discussion. So negative rates work at two levels. The first way is that as QE starts, essentially the central bank buys certain assets, mortgage-backed securities or loan portfolios or whatever, right? And it generates effectively more liquidity for the banks. So basically the banks get more money from the Reserve Bank. That money is earmarked to be lent on and to turn into more loans. To encourage the banks to lend, they would be penalised if they held those balances at the central bank rather than if they actually lent them. So that's the first step in negative interest rates. So negative interest rates nothing to do with retail rates, it's to do with the rates between the central bank and the main banks. And in Europe, what's interesting, look at Germany, look at some of the others there, when they've started charging the negative rates, banks have still decided not to lend more money. So that sort of assumption has proved not to be a very good assumption. The second point is that on the deposit side of the fence, as it were, there's a limit to how low banks can take deposit rates down, because at some point people decide it's no point in keeping money in the bank at all, and they actually then pull the money out of the bank. And so what we've seen in some European countries with very low or even negative rates is that deposit rates have not dropped as far as people expected they would drop, and there's a bit of a floor below which essentially the banks are not able to drop deposit rates. And what that means is that they then have a conundrum, because they have a margin compression issue, because they have a wish to lend more loans at low rates, but they can't necessarily fund it from deposits. And as a result of that, they lend less. So in fact, the momentum for lending goes the other way. And instead, and this is the really tricky part, banks in Europe, for example, have actually speculated more in the derivative section by taking some of those liquidity flows that had come in from the central bank and basically just betted them in on the market. So in fact, rather than helping the real economy, what it's done is it's inflated the derivatives market even more. So that's the sort of the first line argument. The second line argument then is, at some point, when banks essentially get to the point where they are unable to make a margin because of the rates are so low on lending and because they can't take deposit rates any lower, what they might start doing is then charging you to hold deposits. And whether that will be a fee or whether it would be something off the rate, not sure. In a couple of Scandinavian countries, there are now some banks who, for depositors over a certain amount, they actually are being charged, but it's rather at the margin. And interestingly, all the academic research that I've read, and even some of the central banks that have been speaking about this recently, have started to question whether in fact negative interest rates work, because basically it just self-perpetuates this lower and lower interest rate environment, but it doesn't solve the problem. And the European central bank's a great example. They have not solved their liquidity problem. They have not solved their financial problem. And interestingly, if you look at Germany, for example, they're almost running a budget surplus now. So the German economy is not in bad a shape. They could do a lot more, but they're not, and they're just looking at the central bank saying, "Well, you fix it." So now the central bank's perhaps saying, "Well, not sure we're going to take rates low." So negative rates, definitely not necessarily the silver bullet. There's no evidence that moving into negative rate territory solves anything. It just moves the problem on. So going back to the risk thing, absolutely right. So the banks will then dial back their risk appetite. They'll lend to particular types of business. They'll lend less to the SME sector. They'll probably still lend for mortgages because the capital weightings on mortgages are very low, but they won't lend to business, and it just continues the downward spiral, and credit doesn't grow, it shrinks. Okay, CDL says, what is the SHTF plan? What have I done? Yeah, well, okay. Now, this is just my own strategy, right? And, I could be completely wrong. So I went to cash some time ago. I decided that the uncertainties around property and the uncertainties around some of the other asset classes, and even in the share markets, got to the point where it was very difficult for me to see how this was going to play well. So I went to cash. And what I've done is I've spread the risks by putting it in multiple organisations, small organisations, mostly credit unions and building societies. The mutuals have a much less risky strategy. They've got the same deposit guarantee scheme that the rest of deposits have. And by spreading it around a bit, basically you spread your risks. So that's what I've done. I'm not at the moment in crypto. I'm not in metals, because both of those have their own risks, and I believe that those risks are much higher than many people think. Now, other people will be different. They will say, I want to hold gold because I can feel it. And, as I did a post the other week, the thing about gold, of course, is that the price of gold is intrinsically linked to the futures market. And if you look at the total amount of gold in the world and the total value of the futures contracts, there's a one-to-many relationship. In other words, there are many more futures contracts being traded around gold than the absolute price of gold and the volume of gold. And what that means is that people are speculating all the time, and therefore the gold price is manipulated. Even, I guess, you could say the same for silver, although the volumes may be a bit different. And then crypto, of course, there are people who believe that crypto is the perfect solution, no central bank control, etc., except it's speculative because there's nothing underneath it at all at the moment. And my own view is that it's a very speculative environment. You might do very well, you might do very badly, but again, there's nothing to control it. So that's basically what I've done, is I've made it to the point where there is significant liquidity that I can tap when I need to. Now, obviously there are risks. So what happens if the banking system freezes? That's a risk. At the moment, I think it's relatively unlikely. I'm could be wrong, but I think that we will see some tightening in money flow around the economy. And in fact, if you look at the total circulation of notes today relative to where it was, it's gone up a bit, but not as much as some of the other measures. So I think there's less cash sloshing around the system at the moment. One of the reasons why sometimes it's hard to get cash out. But nevertheless, my own read is it's not as dramatic as some have been saying at the moment. So that's my own sort of strategy. And then basically thinking about survivability and thinking about what happens if the banking system goes down for some few days. Well, you try and take account of those things too. So there you go. That's my plan for what it's worth. And I can always grow vegetables in the back garden if I need to, I suppose. So George says, you've put your money in smaller banks, but won't they be bailed out? The bigger banks are likely to be bailed out as they are too big to fail. Okay, so here's the thing. If you look at the deposit insurance scheme, there's a 250k limit per relationship per institution, or group of institutions. If you've St George and Westpac, then it's within that total brand. There's also another limit, which is the total amount of deposits which a single entity could be essentially protected against, right? And that's something like 20 billion or something. So if you're with a big bank, the risk that I see is that there may not be enough in the scheme to cover all the deposits in that big bank. Whereas in the smaller organisation, they actually have less chance of going over the top of that limit. First point. Second point, the mutuals and building societies are significantly less risk-driven, less profit-driven, more leveraged in terms of deposits relative to things like derivatives and those sorts of things. So they're much cleaner businesses, and I think in many ways they're much better run because they're run for the benefit of their members rather than to maximise profit. So my own read has been that they are the ones that I bet on. Now I could be totally wrong. It could well be that the big guys, are too big to fail and therefore they get rescued by the government. They probably will, but I believe that relatively speaking, the risks are lower with some of those smaller mutuals. That's my own personal opinion. Could be totally wrong. Okay, Damien says your thoughts about HSBC and other banks. It's worth looking at the list of banking institutions on the APRA website that are included in the deposit guarantee scheme, because some foreign entities aren't covered. Some are, some aren't. So ING, for example, I think HSBC is as well. So they will be covered under the deposit scheme here, but it's only for depositors in Australia and for the local subsidiary in Australia. Now, the issue with some of the international banks is, of course, if they go wrong internationally, what happens locally? And a good example of that was Bankwest, that was owned by one of the UK banks, and basically had to get bailed out, and CBA took them more than a decade ago, right? So there's an extra risk, I think, with those international banks because of that international axis. And some of those European banks in particular, to my mind, are looking a bit wobbly. And, HSBC is based in Hong Kong. Well, a few things going on there at the moment. So my own sense is the risks may be a little higher, but I still think that the risks are lower than relative to our big four and even our regional banks. Okay, what else have we got? Oh, there's Tony Lacantro. Hello, Tony. Good to see you. I'm going to talk to you tomorrow and get a show done with you. It should be fun. Okay, what else have we got? Tom, just wanted to appreciate your contribution there. Thank you so much. That really is great. Thank you. Okay. A bit of a discussion there about hybrids. Some of these hybrid bonds are really quite interesting. So there are various categories of bonds in the banking sort of structure, and there are some of the hybrids are convertible. So effectively you get quite a good coupon, but you might be converted later into equity. And of course the issue is, if you are converted into equity, at what price is the question. And that's, by the way, the same discussion as you have with deposits. So if deposit bail-in were to happen and you converted deposits to equity, at what price would you be converted to equity, and could you then get out subsequently? So these more sophisticated structures and these risks of being converted in a crisis are real. In Australia, it's all very unclear. In New Zealand, it is crystal clear. So if you haven't done so, it's worth going and looking at the open banking resolution in New Zealand, because New Zealand has been very, very transparent about how deposits would be treated, and the fact that in a crisis, a bank would stop from falling over by converting deposits, bailing them in, and providing support for the bank going forward. So there are powers that APRA has potentially to do similar things here, although of course they deny that they've got them. And there is an IMF directive on Australia to sort this out and give APRA more power to deal with resolution of banks. And there was a paper published quite recently by APRA on their thinking in terms of banking resolution, which I'll do a post on in due course. So Brendan says, if you were sitting on a decent deposit or possibly purchasing outright, would you purchase something soon or continue renting for a couple of years and see how the market plays out? Okay, so here's the question. Are you purchasing for somewhere to live, or are you purchasing for somewhere to invest? Because ultimately, if you are going to buy a property for somewhere to live, and you're less concerned about the capital growth of the property, and you're more concerned about, security and, shelter and all those things, it's still not necessarily a completely stupid time to buy. There might be good prices, there might be good properties, buy in a good street, buy in good locations, and you probably won't be doing too badly. If you're thinking of it in terms of an investment, And many people think of property as an investment. I've got a different answer for you. I think it's highly unlikely that we're going to see much of a bounce in property prices over the next 1 to 2 years. It might be a bit up, but then down again. So many property investors are not getting the returns because essentially the rentals are more squeezed, as we discussed previously. Many of them are interest-only loan investors now switching to principal interest loans, and their payments are going up. I was quoted in the paper quite recently on that. So investors have a much more complicated formula to work out whether in fact they can do anything or not. And my own view is property investing at the moment is probably not a very smart move. And in fact, some of the smart money came out of property investing 6 to 12 months ago and are still out. There are others who still are being enticed in, buy one of these wonderful new high-rise, never mind the quality of the construction. Big questions about the quality of construction. So I think it does depend. I said earlier on, rentals are probably going to continue to, be relatively low. And if in fact you can rent and maybe save a bit as well, that may give you more flexibility later. But it comes back to, I think, ultimately, why do you want to buy in the first place? Joseph says HSBC is based in the UK. Sort of, but it's very strongly connected to Hong Kong, so it's very exposed. Okay, what else have we got? Okay, I missed one. Rumpelstiltskin says you'll get a delayed warning. That's probably right. Yeah. Yeah. It's very interesting just on HSBC. If you look at the exposures that they've got to China and to Hong Kong in particular, they are very much exposed to that. And of course, the unknown in Hong Kong is how this is going to play out. But clearly, Hong Kong is in recession. It's been in recession for 2 quarters now. China's looking quite weak in terms of some of the forward numbers that I'm looking at there. And they've rescued 3 banks, I think, so far in China, and basically have restructured them and allowed them to continue. China's investing big, but they're not investing big like last time. They're investing in different things. They're still building a lot of infrastructure, and they're still building bridges to nowhere, and high rises to nowhere too. So there are some questions, I think, about the status of the China economy, and any bank that's leveraged into that, I think you've got to think quite closely about. All right, now I had a few questions, so I'll just go to 1 or 2 of those questions now. So Scott asked beforehand, is there not an opportunity arising for a small, lightweight, online deposit-only not-for-profit bank that guarantees 0% rates and immunity from bail-in? Well, would be very interested to see whether anybody could make that work. Economically, I think it would be very tough to make it work. The reason for that is that there is a need for a bank to make some sort of margin somewhere along the line, right? Now, if they guaranteed not to pay below, and potentially they could then lend, maybe, but I think the numbers don't necessarily work that well. Online, yeah, there's a lot of demand for online. My research suggests many people will be quite happy with an online bank, and there is an absolute crying need for an organisation to essentially take deposits. What I would say is that some of the recent new entrants have been very unsuccessful in getting deposits coming through the front door. So I think that would be the barrier as well. So I'm not sure that, Scott, that would actually make a whole lot of sense. Now, I saw there's a few questions. Okay, let me just go there. So Genevieve said, did you see the WA Q&A? Yes, I did. In fact, I didn't see it live, but John Adams mentioned it to me. And of course, it's all the stuff that John and I spoke about a couple of months back on our Mandra posts. The social consequences of bad policy and bad lending and all of those things are real. And I guess the point I'd like to make is that the show I did in Wollongong last week was trying to make the point that there are some leading indicators in many other local economies of stresses and strains as well. Not as significant as WA. So WA has been at this for 5 or 6 years, right? And it takes a bit of time to work through. But there are some early leading indicators, lots of police signs, difficulty in terms of actually finding businesses who want to actually take premises, a lot of construction that maybe won't be sold. Those are quite similar stories. So I'm afraid that the social consequences of this stuff is where we are going to have to focus. So, I said to John the other day, we're going to have to really get further into the conversation about the consequences and the so whats of this poor policy, because it isn't just financial, it isn't just an academic exercise. It touches real people, and those real people get into terrible trouble, and often, they don't leave with their shirt, so it's a big deal. In terms of 24 to 12 months ahead, I think it's 2 or 3 years probably. It depends how it plays out. But the worry I have is that the leading indicators that were over in the West 3 years ago, I'm seeing now in Western Sydney, I'm seeing in areas around Melbourne, I'm seeing in other, and that's to do with mortgage stress, and that's to do with lack of job opportunities and employment and underemployment. All of those leading indicators, I watched them grow 2 or 3 years ago in the West. I'm now watching them grow in other places down the East Coast, which is why I'm quite negative in terms of how this might play out. All right. Another question. Mr. Nugget is suggesting that we start gradually pulling any cash we have out of the bank accounts and gradually port the funds into cryptocurrencies and converting money into scarce metals such as gold and silver. This is before governments such as Oz invoke bail-in and cash limitation restrictions. Discuss. Well, I will discuss in a second, but I need to just put another question up through, and it's this one here. Can you please clarify what you're looking at with M1 and M3? Is this QE? What's going on? And an explanation of the monetary aggregates might be good for the audience too. So those two are two parts of the question, because Nugget actually did a post the other day basically saying M1 has gone up dramatically and that's a sign of QE. Now, actually, there's another story that we should tell. So this is from the RBA aggregates report. And the first thing to say is that M1 is defined as currency plus transaction deposits with ADIs. And this is very important. Prior to July 2019, M1 was defined as currency plus only a portion of transaction deposits. The new definition brings M1 more in line with international reporting standards. From July 2019, the new framework for M1 was revised to 2002 using historical data. Historical data is not available prior to 2002. So the point to make there is that M1 has been redefined as part of this exercise, in fact, in redefining a whole lot of metrics. So bear that in mind. M3 is defined as M1 plus all of the deposits at ADIs, including negotiable certificates of deposit from private non-ADI sector. Broad money is defined as M3 plus other borrowings from private sector by AFIs. And the money base is defined as the holding of notes and coins by the private sector plus deposits of banks with the Reserve Bank and other Reserve Bank liabilities to the private sector. So M1 is the narrow measure, but now including deposits. M3 is the slightly broader measure. Those are the definitions. Now, here is what happened. So this is the M1, and you can see there this is a very significant rise, but that very significant rise in M1 is simply to do with the redefinition of the data. So this is not to be interpreted as RBA suddenly doing quantitative easing. M3, grown, but not to the same extent. Broad money, mapped quite similarly. And the money base, and it's worth making the point that the money base has not grown anything like as much as M3. So what I said earlier on about the fact that the notes and coins in circulation relative to the total economy is lower than it's ever been, that's what that data is saying. But my point there is that M1 and M3, tells you what's going on. The reason that M1 changed was because of a change of definition, not because of RBA QE. And in fact, just to take that slightly further, change of existing financial aggregate data, the more detailed guidance likely to result in changes to the financial aggregates. The new guidance in principle place of residence will lower owner-occupied lending and make higher investment housing lending. So there were some changes in the investment lending data. And M1 will be higher with the inclusion of all transaction deposits. However, given the holistic nature of the changes, it will be too early to say what the broader impact of the introduction is. The key point to make is those changes were all to do with changing the data, nothing to do with RBA doing QE. So now let's go back to that question. Mr. Nugget suggested that you should start gradually pulling any cash out and porting the funds into cryptocurrencies and converting money to scarce metals such as gold and silver. So if you think that the whole monetary system is about to collapse, that's what you do. There is nothing in the M1 data that would signal to me that we are at that crisis point. So I think you should be a little bit cautious with Mr. Nugget's suggestion here. And I've told you before, there are risks attached to gold, silver, and there are risks attached to crypto. So it's not like you jump from a risky environment into a non-risky environment. What you're jumping to is from one risky environment to a more risky environment. So that's why I think it's quite important to just be a little bit cautious. So hope that's of some help in terms of trying to unpick M1 and M3 and to essentially explain what's gone on. It's to do with a change of baseline. And we're going to see more changes, by the way, to the data over the next few months as well as we go. Yep. Sorry, Steve. Yes, you're right. I forgot to flick the graphics across. Hey, what can you do? You have to get better staff is all I can say. Okay, now what about wage growth? How can the government get it moving into the right direction? EGS 123 able. Well, it's a very interesting question because the wages data, as I showed earlier on, is very weak. And it's part of a global problem. In fact, wages are weak around the world, not just here. And so if you read some of the academic papers that I've done, they're trying to say, well, it's to do with globalization because effectively you can get things done more cheaply elsewhere rather than here. It's to do with computerization and digitalization and all those things. It's to do with the reduction of the power of unions and their ability to negotiate. And it's to do with the big multinational companies and their ability to push their own agendas, and all those things are all part of the story. So these are big, complex things. And, I'm not sure that there is a clear path to higher wages ahead. The RBA is saying they need to see wages down at about 4.5%, unemployment down at 4.5% to see wages start to return. It's very hard for me to see how they can possibly get unemployment down that low. And that means that, with the sort of the Phillips curves and all those sorts of things, the normal way you do it, it's very hard to see how you can get wages growth anytime soon. So we could be in a wages crunch for another decade or more. And for many people, the wages that they are taking home now in real terms are lower than they were 10 years ago. And that's a big deal. So there's an economic conundrum here at the heart of wages growth. And I don't think at the moment there's a clear line of sight to how to solve it. There are a couple of things that people might consider. There is this idea of a universal income. That's an MMT type of thing, right? Basically saying, well, if we give people more money to spend, then they'll spend it, and that will help to basically drive more economic activity. But, gee, that costs quite a lot to do. You can try and target wage growth. That was done in the 70s and 80s in some countries, but never worked very well because basically there were always ways around it. The other thing to bear in mind is the gig economy, and I think the gig economy is probably part of the reason. We've got more people in part-time work, in fragmented work, in odd hours here and there. So the nature of work has fundamentally changed. And if you put all that together, then my own perspective is I think it's highly unlikely that we're going to ever see the wages growth momentum that we had even a decade or two ago. It's going to be much more fragmented. It's going to be much more spread. But if you look at those at the top of large organizations, CEOs, the ratio between those CEO pay levels and the standards have gone through the roof. So what I would be thinking about is maybe there's some things we need to be thinking at the top end of the town to pull some of those back, because maybe that would give us a path then to perhaps sharing the pie more equally. The problem that I see is that inequality here in Australia and in the US and elsewhere around the world has got worse. It's been supported by the QE and it's been supported by central bank policy. The rich have got richer, much richer. The rest are much poorer, and the middle class is being absolutely squeezed. And at the moment, I see no real appetite to address that. Now, UK is interesting, of course. There's an election running on there at the moment, and the Labour Party there has gone quite hard left and is trying to advocate a whole series of policies to try and tackle wages growth. But if you look at those policies, they're sort of back to the 1970s again. There's not a lot of innovation in my mind. So I'm not sure that, one, they'll be successful, and two, I'm not sure that they'll get voted in, basically looking at the polls that we're seeing there. So I think wages growth is a real conundrum. Joe Wilkes says, in New Zealand, there's only $6.2 billion in cash. That's less than $1,200 per person in the event of a banking issue occurring to the 5 million population. That's all the cash we have. Yeah, we've got a very low level of cash here in Australia too. Now, call me a conspiracy theorist for a second. Is that partly to do with the cash ban? I know there's a big discussion in New Zealand about the future of cash and, should you keep as much cash? I got very frustrated with the cash ban because basically this is a civil liberties issue. This is a dumb policy, and hopefully everybody on the channel here put their submissions in and we'll see what happens. So, but no, it's very interesting. The amount of cash in circulation is a lot lower than it's ever been, and that's a big deal. Okay, what else have we got? Genevieve asked about, do I agree with the melt-up thesis of the markets, i.e. US flowing into Australia? Well, I guess the question is the US likely to go into recession next year or not? And, there are many people who believe that it will. I think even some of the big names are expecting a really bad time in the US next year. There are others, including, of course, the central bank, who says, no, everything's fine. We've got it all under control, despite the fact they're doing this funny QE, not QE stuff, all the repos, despite the fact they're buying more treasury bills, despite the fact that they've got liquidity now pouring into the markets to try and keep the banking system on life support. The leading indicators are not good in the US. And I've discussed this a few times on my weekly updates. The economic measurement, if you think of things like the flow of goods, is way down. If you think of business investment, it's way down. If you think of the implications in terms of the buybacks that have gone on, so companies have basically got cash at very low rates and just bought back their shares and lifted their share price, but that's an artificial thing. All of those factors together suggest to my mind that the US is looking quite wobbly. Now, of course, if the US does go wobbly, that's going to have a massive impact on Australia. The liquidity impact in Australia, if the US went off, would be really significant. And I think it's highly unlikely that we would avoid a significant problem. I also think that we need to think about a local situation here, because the Reserve Bank will probably take the dollar lower in an attempt to try and actually stoke inflation and to try and deal with some of the issues that we touched on earlier on. And so there could be a crisis locally to do with the dollar. There could be a crisis internationally to do with the US. There could be a crisis, Europe or China. All of these big picture issues are there. How likely they are? Well, your call is as good as mine. But the leading indicators don't look flash to me, and there are many people who are talking about it. That then takes you to the discussion about the conspiracy theories that, somebody's blowing up the economies deliberately to be able to create a new economy beyond, maybe. I believe in the cock-up theory of history. Personally, I think it's more likely that there's groupthink going on among central banks, that many economies are behaving in similar ways because of that, and that essentially we're going to muddle through for some period of time yet. But I think unless we come back to the fundamental question about debt and how we deal with debt and how we ultimately unwind some of the debt that we've got, we're not going to get out of this in any clean way. So I haven't directly answered it because I'm not sure which way around it's going to go, but I think we should watch the US. That's why in my weekly property imperative updates, I always focus on the US, because I think it's a critical element, not just over there, but on our local economy here. Okay. Yeah. So there's a comment there saying that the US and China thing is looking pretty wobbly. It is. Yeah. There's some good news and bad news, good news, bad news, swings all over the place. It's an ideological fight between the US and China. That's the problem people need to understand. And even if we get a phase one agreement, and they agree to buy more pigs from the US and what have you, the underlying currents between those two economies is really, really worrying in my view, because we are talking about ideology here. We're talking about the very basic assumption drivers of different economies and different philosophies. And that's, I think, the thing to watch. So Rodney says, do unconfirmed auction results get confirmed at some point? Where is the updated data available on a weekly basis? Auction clearance rates. Yes, well, I had a number of people beforehand asking about auction clearance rates too. Look, it's clear to me that there are some funnies in the auction clearance rates. We know the number of auction clearance rates that are listed. We know the number of auctions that are listed ahead of time. And in fact, Cookie Boy puts them up pretty much every week on Twitter, right? In a Sydney, 400, 500. And then we get 700, 800 reported. How does that work? Well, I think it's because what happens is sales that were already made get rolled in, and essentially there's also some double counting. And we also know that the geographic areas in some cases have got to be bigger. So they've sucked in, other areas that perhaps wouldn't have been in the original numbers. So the auction clearance numbers are very wobbly. And what I find fascinating is everybody sort of saying, massively high auction clearance rates, but the volumes are still quite low. And then if you dig in a little bit further, you'll discover that the basis of the calculation is a bit shaky. And there was a very, very good post on Heisey said, where he actually took this apart. If you've seen it, go look. It's really interesting, because basically the domain numbers that they quoted were miscalculated. So there's a whole bunch of miscalculations. There's also a question of clearance rates that were prior rather than the clearance rates that were actually on the day. And I have a feeling that some of those are actually added in for effect. So my belief is you can't trust the auction clearance rates. And by the way, there's always a bias towards real estate agents supporting sales when they've actually been positive rather than not. And of course, many are not disclosed from a price perspective. So ask yourself the question, how do those price data flows get into the price indices? Because you have the auction, right? There's a price on a small proportion, but often it's not disclosed. How does that information get in? In fact, the only source that I can see is the REA data set through HomeTrack, because there, real estate agents are required to put in the data to be able to take a property from for sale to sold in the system. So that's the best source, and that's the one that's talking about a 0.8% rise in Sydney over the last quarter. So just word to the wise. Okay. Let's see what else we have here. Okay, I'm just going back to my other questions here. This is, again, stuff that's come in beforehand. Do you think that the RBA and the federal government can perpetually hold the economy and the real estate market up through interest rate cuts, and when they are exhausted QE? Well, they'll certainly give it a damn good try. But there will be a limit to what they can do, and essentially the amount of QEing, and by the way, there's not even good evidence in Australia yet that the QE can necessarily work as well here as it did in other countries too. Not least because there's a quite limited pool of assets that can be QE'd, so that'll be an interesting thing in its own right. it's a big deal. So they'll try. There's no doubt in my mind that the RBA and the federal government will do more unnatural acts. I've spoken about unnatural acts before to try and support the economy. They will ultimately, I think, not be successful forever, but it could take a long time, and they will do quite a lot, both formally and informally, and all those good things as well. Expect to see the first-time buyer grant expanded for more people. All of those things. Another question. While there is a direct relationship between interest rates and real estate, is there any obvious connection between how QE would support real estate prices? Well, what we do know is that where QE has been done, asset prices have been inflated, and that's true in real estate and it's true in stock markets. And that's because basically there's more money chasing the same assets. So it is quite likely that we will see that supporting some asset prices. The question is how much? Hard to know, but it tends to make those assets bigger. In other words, the more affluent people benefit because the stock market holdings go up, the value of their properties go up. People trying to get into the market or to buy into other asset classes for the first time just find it more difficult. So it creates a greater wealth divide, unfortunately. To manage any financial shock, such as the failure of a bank like Deutsche Bank, do you anticipate that central banks will just step into the breach and nationalise it? There's a really interesting tussle there because last time around in 2008, a lot of banks were nationalised. We're in the UK, there were banks bought around the world. In fact, the bank that I'm still with in the UK is still partly nationalised because it was part of that rescue package. But the central banks and the IMF and all those other players around the world have said we can't do that again because it costs the taxpayers billions and billions and billions, and they're still paying today. So alternative strategies are now being laid out to try and stop public rescuing of banks. And that can include deposit bail-in. It can include a rescue plan to restructure the bank if it fails, and a bunch of other things, and divide and conquer and split up into pieces, all those things. So it's not a lay down misere now that a central rescue operation would be mounted by a government. It might, but it might not. And interestingly, I think Deutsche Bank's an interesting example because there are issues about Deutsche Bank in Germany and issues around Deutsche Bank internationally. It's probably they will do something locally in Germany if Deutsche Bank fell over, but they may not do anything internationally. So that could be quite an interesting tussle. But so it's not as clear as I think perhaps it once was. These alternative resolution strategies have definitely come to the fore. I worry about deposit bail-in, as I discussed earlier on. And the last question there is, most of the world arrives at near zero interest rates next year, and many are running QE programs to stimulate the economies. What comes next? Good question. More of the same? How low can you go, right? How deep should interest rates be allowed to go? And remember what the IMF paper said? That will only work if you can stop cash leaking out of the economy. So expect cash bans, expect money to be trapped inside the banking system. That's almost critical if you're going to actually do real deep negative QE and negative interest rates. I have a feeling that we may not go there because of my arguments earlier on that in fact it's proving not to work. But if you do, hard to rewind, hard to get back out of. Look at Japan. The Japanization of economies around the world is what I'm worried about, because I think we're laying the same traps as the Japanese currency did and country did a decade more ago, and they really haven't got out of it. So far, I've not seen anybody track back out. The Fed tried to lift rates. They then tussled with the markets won, and now Fed is on a QE bias again. So very tricky. Okay, let's just go back and see what else we've got. I'm referring to wealthy banking families, no mistake in there. They've done it over and over again. Yeah, so there is an interesting discussion to be had, probably not on this channel at the moment, about the role of some of those very well-connected families and those sorts of things there. Remember that not all central banks are owned by the government. The Fed is effectively private, although the Reserve Bank in Australia is owned by the government here, effectively. So we own it, believe it or not. The way they behave, you will sometimes wonder. But so there are some variations. But no, there are people who believe in centralized conspiracies about effectively blowing out the banking system and all those things. I'm more the cock-up theory guy myself. Yeah. Now Joseph makes a very interesting point. Should we be talking about different generations rather than nations, monetary policy, money creation by debt in a digital age? Yeah. I'm worried about this intergenerational thing that's going on, right? So we've got an older generation sitting on significant assets, and most of that's in property. You've got a younger generation who's struggling to get in and perhaps have different sets of values. And you've got people in the middle who are sort of, trying to get in or just, in property at the moment, but with no real hope of income growth, lower levels of asset growth, potentially, and higher levels of risk in terms of employment, unemployment. And then curly bracket over the top, and this is the one I think we should be talking more about, climate change. To my mind, we can't avoid the true implications of climate change in all this. And, the fact that in Australia we're just ignoring it is very, very concerning in my mind, because this is going to have huge impacts on the economy. We're already seeing it in the farming sector. We're seeing it, of course, in all the fires and those things. But we're also seeing it in things like, for example, property. So the value of property close to the coast will go down as sea levels rise. The amount of sea level that's being predicted is now 2 meters to 4 meters, much higher than people expected earlier on. That will risk thousands and thousands and thousands of properties that currently today are actually very valuable properties, but in a generation will be worthless. This is a big deal, right? And so I think there needs to be some joined up thinking, and unfortunately we don't have it here in Australia or perhaps in other places too. So there are some big picture issues I think we need to think about, and I think the intergenerational conversation is a very important one, but I think there are also some common issues that all the generations need to actually corral around. What I can tell you is that the previous baby boomer generation is responsible for a lot of stuff. I'm responsible for a lot of stuff because I'm one of those as well. But the way we lived is not sustainable, and that is a very important point I think to make as we go forward. Okay, what else do we have? Bondi Steve says it's time for a break. It's 9:18. Yeah, we're getting close. 9:26 now, so we're pretty much at the end. Okay. Bryce says, will this be uploaded for later viewing? Yes, it will. So there'll be a full version of this particular thing uploaded, including all the pre-chat. And then there will also be an edited version with a couple of behind-the-scenes clips as well. So they'll both be available, and they'll be up tomorrow. So I'm just going to come back to the last part, so the last couple of minutes, and then we'll call it a night. So just in terms of where can you get more information about DFA, look at our blog. The Digital Finance Analytics blog is where I put all the information about what we're doing. You can get in touch with me directly via the blog. You can subscribe on the blog, and you'll see all of the posts from the YouTube channel, but a lot of other stuff too. So that's worth subscribing to. And just so you know, we've got a good number of people there on the blog. You can also support us via Patreon. A number of people have. We really appreciate that support. Helps us to continue to do what we do and to pay for the work that we do. Or you can make one-off donations via PayPal. All the information's in the comments below, and also on the site as well, and on the blog. And I even run Bitcoin. I mean, what I said earlier on, crypto is not a huge interest to me, but people kept asking, so there you go. You can even actually do Bitcoin if you want. In terms of top hits this month, I just want to highlight the Jolly Swagman podcast with the housing bubble. That's a really, really important podcast if you want to get to understand housing bubbles. There were also one we did last week with Joe about out and about in Wollongong. Very important one, showing some of the social consequences of poor planning and the financial pressures that the local community down here are under. There was a 30,000 and counting post. We have more than 30,000 people on YouTube. I just want to say thank you to all of you who support me in what I do on YouTube and come back and keep commenting and being part of the community. Terrific. Add up all the other channels, including Twitter and my blog, and I've got 60,000, just over 60,000 now. So the reach is actually significant. And then we have another 18,000 on the Interest of the People channel, which is where John and I also do stuff. So we are actually beginning to create a bit of momentum, which is terrific. And again, I want to say thank you for your help in doing that. We continue to do our Imperative Weekly updates. I've tried to make them a bit shorter, a bit more net, but hopefully very useful. We will continue to do that for the foreseeable future because we think it's important. Also, I learn a lot from doing it. And then just, some of the other people we've worked with, Edwin and I did a post the other day. Edwin's always great value. I'm talking with Tony Locantro tomorrow. I'm also talking with Chris Bates, our mortgage broker, in the next few days, and he'll be on the show. And I've got some other guests planned as well. And of course, still working with John Adams on the Interest of the People channel. And of course, we've been talking about the fishy assassination of Australia's property price debate, which is all about these indices. So go and look at that if you haven't done so. It's some very important debate. So I think that's pretty much it for tonight. I'm just going to have one last quick flick over just to see whether there's anything else that I've missed. I probably haven't answered all the questions. I never do. I really apologise. If there's something you want me to talk about, drop me a note and I'll come back to you privately. You can do that via the DFA blog straight away. But I think we're pretty much up to time. So thank you very much indeed for spending time with me tonight. It's been a good, hopefully a good conversation. And the interesting conversation point is, of course, is that there are more stories to tell. There are more conversations to have. And I'm looking forward to continuing to share my experiences and my thoughts and my perspectives with you. And please share the posts, share these thoughts, and help to make people more informed. Remember, what we're doing here is providing a perspective, some ideas to help people become more informed and more educated. We don't necessarily, get everything 100% right all the time, but nevertheless, I think the perspectives we have are really important. I'm looking forward to doing another show with Joe. That'll be great. So we'll get New Zealand back on the radar again. Lots to talk about there. There's some good conversations coming as well in terms of some of the social consequences of all the stuff we've been talking about. And I'm sure we'll be talking about property price indices once again. So with that, I want to say thank you very much for spending some time with me tonight. It's been great. And I will look forward to catching up with you once again next time. There will be a post next month in December. So I look forward to seeing you then, third Tuesday as normal. And have a lovely evening. Thank you very much. We'll see you next time. Martin North from Digital Finance Analytics, signing off.